Welcome to the 401k Resources channel with Matthew.Knight. This series breaks down employer-sponsored retirement plans for both employers and employees. Each episode covers everything from basics to advanced strategies with expert interviews and relatable stories. Join Matthew to learn how to take control of your retirement savings and build your future.
Hi everyone, in today's new video series, I have Mark Robinson, Vice President, Retirement Plan Services with T. Rowe Price. Mark, welcome.
Hey, thanks for having me.
Yeah, you bet. Yeah, so you mentioned glide path, and I think that's a good segue into the next topic. Let's say I'm a participant and I've been transferred into a new 401k, or my employer has started one up, and suddenly I find myself into target date year 2030.
Yeah.
My buddy next to me has got one that's target date 2055.
Yeah.
And you talk about glide path.
Yeah.
Can you explain a little bit for those watching what that's really going to mean when you see that year tagged on to the end of the fund?
Sure. So the year of the fund is when you're approximately going to turn 65 years old.
Okay.
So if I get enrolled into a plan and I never make an investment selection and I am in that 2055 fund, that's approximately when I'll be 65 years old. So what's that, 30 years from now? So I'm 35 years old. The nice part about it is both funds are accurate based on your age. So somebody that maybe is 50 can't handle the volatility that a 30-year-old can have,
Of course,
because they have so much time to get to retirement. Whereas in 10 years, you might need that money a little sooner, and you don't want to see the ups and downs in the markets. So if I'm a 25-year-old and I'm auto-enrolled and put into a target date, I'm probably in a majority of stocks and funds that are going to be more volatile than if I'm a 60-year-old, where I'm more in bonds and cash.
Right.
And the beauty of it is, if I never log into my retirement account, I never look at it again, that glide path will automatically reallocate you so that less stocks happen and more bonds, so that you're a little more conservative coming closer to retirement age.
Yeah, good. So Mark, it would be like this. I'm younger, I'm heavily allocated to stocks. Glide path means I'm gliding towards a more conservative allocation as I near my target age,
Yes.
which is 65.
Yeah.
So in the beginning of this era of target dates, go back to the early or the mid 90s here, they might have gotten a bad rap when they came out. And a target date fund is sort of a fund of funds. It's a fund wrapper with a series of other funds tucked inside. Would you say that's a pretty accurate description of how it's built?
Yeah, I would say, again, it goes back to that diversification, right?
Yeah.
It's not just one company you're buying. You're not just buying one stock. It's a group of mutual funds that all invest in different things. So that goes back to that don't put your eggs in one basket kind of idea.
And since it's a good qualified default for a plan sponsor, very compliant there if the employer doesn't make an election, but can definitely come back and make an election later if they want, not stuck in it. Mark, I appreciate these valuable insights. Thanks for coming into the show today.
It's my pleasure.
Thank you, Mark.